Maggie here with Verified Investing, answering your best questions of the week. Today, I want to answer a question in regards to trend lines and taking them to the upside or the downside. So, the question was we often talk about price hammering trend lines to the downside, leading to breakdowns. Does the same probabilities apply when price repeatedly tests trend lines to the upside? So, it does still apply. So, anytime we are hammering a line over and over and over again, the chances of it breaking go up. So as you can see here, it's just the chart of the S&P 500, and we have a upsloping trend line and above price and below price. So in this situation, because price is going up, we're anticipating this to break to the downside. So that's where we're saying we would look for it to break to the downside. However, repeated tests here do weaken this line. It's just the chances of this continuing up higher above this are lower. And so this is another example where we would anticipate it breaking to the upside because in this case, price is going down. So really, the concept here is we're anticipating it to break the opposite way that price was trending. And so that's why we said only to the downside versus the upside. So in this case, we would be looking for it to break to the upside. And the more times it hits this upper trend line, the more probability that it is going to break. And so on the downside here, the chances of breaking to the downside is lower because this trend is already down. So we'd have to pick up more momentum to break out to the downside. So that's where the concept comes from. And I hope that answers your question.